Today, the thing moving Bitcoin most isn't Bitcoin. It's a phone call about Iran. The president told Congress yesterday he expects the war to end quickly. The Senate is moving a joint resolution to wind it down, and Bitcoin is up. Not because anything changed in the protocol, not because someone announced something on-chain, but because risk assets are catching a bid on geopolitical hope. And that one fact, that crypto's price is being set in geopolitics rooms rather than crypto-native ones, is exactly why this channel needs a third pillar. Crypto used to be its own world. Headlines were about halvings, forks, and white paper releases. In 2026, the headlines moving the most volume are about ETF flows, Fed minutes, and what a Treasury company's CFO said on an earnings call. That isn't an accusation. It's a stage of maturity. But it does mean that if you're watching crypto without watching macro, you're watching half the story. Look at this past week. Spot Bitcoin ETFs bled $649 million on Monday alone, on top of nearly $1 billion in net outflows the week before. Spot Ethereum ETFs are on their 6th straight day of redemptions. But the picture isn't capital fleeing crypto. XRP and Solana ETFs are quietly drawing modest inflows at the same time. The institutional bid hasn't gone home. It's rotating. The wrapper that worked for Bitcoin and Ethereum exposure in 2024 isn't where the marginal institutional dollar wants to sit in 2026. And it's rotating towards something specific. The SEC is preparing what it calls an innovation exemption, a regulatory framework that would let crypto-native platforms offer on-chain trading of tokenized U.S. stocks. Tokenized versions of Apple, of Tesla, of the S&P 500, trading 24 hours a day, with near-instant settlement on the same rails as Ethereum DeFi. The framework could land as soon as this week. The tokenized equities market is already at $1.4 billion and growing 30% in the last month alone. Nasdaq got tokenized trading approval in March. The NYSE got theirs in April. The DTCC, the institution that clears almost every American stock trade, is planning to start production tokenized trades in July. This isn't a side experiment anymore. It's the actual direction of capital markets infrastructure, and the institutional money pulling out of BTC ETFs can see that road being paved. There's one more thread worth pulling. Strategy, the company that built itself into the world's largest corporate Bitcoin holder, with more than 818,000 coins at a cost basis, around $75,000 per coin, told investors on its May earnings call that it's now willing to sell Bitcoin when the accounting argues for it. That's a real break from the never sell stance that defined the corporate treasury thesis for 5 years. Strategy actually bought more Bitcoin the week after they said it, so this isn't a fire sale. But the doctrine has shifted. The absolutist version of buy Bitcoin and never look back is no longer the institutional template. The new template is more flexible, more tax-aware, more macro-conscious. Less religion, more spreadsheet. None of this is crypto losing. Capital isn't fleeing, it's growing up. ETFs as wrappers, treasury companies as buyers, tokenization as the bridge to traditional markets. These are different shapes of one thing, an institutional position that's getting more sophisticated. Watching what happens to crypto in 2026 increasingly means watching ETF flows, Fed meetings, regulatory calendars, and yes, sometimes a war. That's not a betrayal of what crypto was supposed to be. It's what every monetary technology eventually goes through when the world starts taking it seriously. Welcome to Macro Meets Crypto. We cover crypto on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.